What role do incentives play in economics? Have you ever wondered what really drives people and businesses to make decisions in the economy? The answer lies in incentives. In economics, incentives are key factors that influence how individuals and firms behave. They shape actions within markets and are especially important in capitalism. In this system, incentives motivate efficiency, innovation, and growth by rewarding productive activities and discouraging wasteful ones. At its core, an incentive is anything that encourages or discourages a specific behavior. In capitalist economies, these incentives often appear as profit opportunities, financial rewards, or competitive advantages. For example, when a company sees a chance to make more money, it will work hard to produce goods and services that consumers want. This drive leads to lower costs and constant innovation to stay ahead of competitors. The price mechanism is a vital part of capitalism. Prices act as signals for both producers and consumers. When demand for a product increases, higher prices encourage firms to produce more or create better products. On the flip side, lower prices can deter inefficient production. This back and forth creates a system where individual profit motives align with overall economic efficiency and growth. Incentives also play a major role in encouraging innovation. Entrepreneurs and companies are driven to develop new products and technologies because successful innovations can lead to greater profits and larger market shares. This ongoing competition fuels economic progress as businesses continuously seek improvements and cost reductions to attract more customers. Additionally, incentives affect how resources are allocated. In a capitalist system, private ownership and profit motives guide resources to their most valued uses based on market demand. This is different from systems where the government controls production and prices, which often lack strong incentives for efficiency and innovation. However, incentives can have complicated effects. For instance, some government incentives or subsidies might distort markets by encouraging behaviors that do not promote efficiency. Still, in a well-functioning capitalist environment, incentives generally lead to increased productivity, technological advancements, and improved living standards. In essence, incentives in economics, particularly within capitalism, act as the driving force behind economic activities. They encourage efficiency, innovation, and growth through the pursuit of profit and competition in the market. By aligning individual self-interest with broader economic benefits, incentives are central to how capitalist economies operate and develop.